Hello friends, so I'm here again and I wanted to dive deep into this tracking error attribution of portfolios. So if you remember a few months back, I posted one post and video for attributing tracking error for a portfolio where I did the same exercise of figuring out the contribution of different curve tenors like T-rate, 1 year, 2 year, or 3 year durations at the portfolio level. Okay, it had only like tracking error attribution at the curve level, but it did not have other risk factors like FX or even the credit spread. Okay, only curve attribution was there. It contained marginal tracking error and the contribution to total tracking error. Okay, so now in this exercise and in this model, in this next iteration, I have done the same thing but extended it to FX and also credit spread. Okay, and I have done the same I have done the marginal. I have calculated marginal tracking error and also the contribution of different contribution of different components. If you can see my screen now, okay, I have uh, done the contribution to 1 to 10 year tenor terms, okay, and also the credit spread for spread to government bonds, okay, and also for the FX exposure for non-base currency portfolios, bonds. So in my fictional portfolio, okay, my base currency is euro, and I have some positions which are in euro, some are in US dollar, and yeah, so this is it. And if you are able to see my screen, okay, so I will come back to it. I wanted to cover the methodology first. So what is my methodology? Okay. So okay, first I wanted to cover the data points. So I have taken last 5 years of monthly rates from Fed side. Okay, so I have covered like 1 to 10 years of, okay, we have the rates here. Okay, most of it figure out. Yeah. So here are. So here are the last 5 years of rates. I have GS1 government security 1 year, 2 year, 3 year, 10, and this is the OAS column. Okay, it is a monthly option adjusted spread. This column I, okay. Currently, it is only for a single credit rating, like rating A. So I have assumed all my bonds in my portfolio are A rated, but it is wrong. But it can be extended to further that a portfolio can contain many bonds of many credit ratings. Okay, some could be triple A, some could be like triple B or double A, right? So for simplification, for now the portfolio has only A rated bonds. And now this is the rating. Sorry, this is the FX rate, euro to USD. It means how many euro you can buy in one day. And on this year, 1999, first of Feb, okay, this was the rate. In 1 USD, you could buy this many euros. Okay, it extends up to actually 25th, 2025 April first. So this is the same data which I used in my last iteration. I have extended it to OAS and FX. Yeah, and this is the for bond holdings. Okay, let's try to see what was the flow. I had my holdings, okay, and their weights and benchmarks and weights. And let me show you my holdings file as well. It is the same file. It had like fictional securities. Okay, so I have tried to keep this data as real as possible. But bear with me. So these are the weights in my portfolio. Okay, these weights sum to one actually for portfolio and one for a benchmark. Okay, so below our benchmark portfolios, and uh, and this is the rating. Okay, everyone is A rated. Okay, again a simplification. Okay, each bond can have a different rating, and portfolio based currency was euro and holding currency was USD or euro. Okay, so as we know, if you are reporting currency is euro, right? Base currency is euro, then obviously you are reporting in euro to European regulator and European uh, investors, then you would want to convert your USD position to euro. Okay, then come to FX risk, right? That's why FX attribution. And you would soon know that FX plays a very important part, okay, actually even more than the rates. Because in this portfolio, FX plays a bigger part even than the rates, okay, and even than the option adjusted spread, okay. And option adjusted spread is it is an indicator of default risk also, right? It is an indicator of like credit risk. So yeah, and these are the usual columns like issue date, call date. Yeah, so all of these are callable bonds. If you remember, my last iteration of tracking error volatility attribution model. So I have used QuantLib library, and so these attributes are helpful, and so these are important columns actually. Open is important, maturity is important, okay. And I forgot to remove this column, okay. Column M is irrelevant for this exercise, okay. But let's see what is the flow. So I have shown you the time series of absolute factors, okay. So this count the first step I showed you the rates and time series now. Now I calculated monthly changes, okay, of absolute values. I determined the changes. It was simple, okay. I just did subtraction. This is subtraction exercise equal to this minus this thing. Is it cannot get worse than like subtraction. For the FX, it was a little bit different because for FX, as you know that it is like a percentage return sort of, okay? Percentage return, okay? It's not like absolute difference, okay? It's like this. Okay, for FX, it was this. But that is the only thing. For OS spread also, it was absolute difference, just like this. Okay, for FX only, it was different because of the market convention. Then, okay, you have calculated the monthly changes of absolute factors. Okay. Then I calculated KRDs and credit spread. Okay. So I wanted to show you, okay, how I did that. Okay. I'll do that. So this is supposed to be very simple exercise. Okay. Calculated. So let's try to see how I calculated KRD. Okay. It would make sense. Let's go inside. How did I do that? So I take the coupon rate, issue date, maturity date, okay? And then call date I take then this is the schedule, and it is all built on QuantLib, okay? So this is the backend, like the basic engine for calling the bonds. Then so it is like creating like call schedule, okay? Call schedule or coupon schedule. So this is all again call schedule, okay? And this is for yield curve where I fed in my rates. Okay, if you remember in this, if you go here, okay, so in the rates schedule, okay, what are the current rates I fed in these rates? Most of latest rates I fed it. Right. So these are the most latest rates, zero rates. Okay, I fed in. So you can get it these rates from Fred's site. Let me show you this. This is a Fred site actually. You can get it. And from OS spread, you can get it from this, okay? And this link is for like A-rated bonds, okay? A-rated. There's a double B rated bond, also triple B, high yield, triple A, okay? So there are separate links for that. Okay? You can get OS spread, which is published by Federal Reserve actually. For it is very good free data. You can use it in your experiments. And and Fred also provides you FX rates. Is not that awesome? They also provide FX rates. So all this is free data, good for experiments and learning. And so here we are. Okay, call date. Then you build the callability schedule. So what I'm trying to do actually, okay, why all this exercise? I just want to get a bond price, simple, 100 notes, okay, nothing more than that. And one more thing, actually, I have used only one yield curve. If you see, I have used only one yield curve. I should have used two yield curves because my portfolio has USD and Euro. I did not. Again, for simplification purpose, but you can use, just like you can use multiple rated bonds in your portfolio. All right. And this is Helvite model. I paused in the yield curve handle. Again, if you remember, I paused in the zero rates in the yield curve model. And this is, I think this is mean reversion parameter. Okay. How fast your rates convert to the mean or the long-term rate. Okay. This is, I think, the mean reversion rate. Okay. And this is sigma, volatility of rates. Okay. So this is also called location. No, it is not. I think this is volatility. So sigma is volatility. I assumed it to be constant, but again, this is a derived parameter. Okay, and this is alpha. Okay, and then I fed in the alpha this hull white model into my engine. You see, it is a three callable fixed stated body. So QuantLib provides different engines for every type of bond. So this is a fixed stated bond, right? So it was callable. So there is a callable bond, but there are more engines you can use. So now I have passed the hull white model, did the alpha and the sigma. And the good thing is that, okay, I passed in notional here. Yeah, you see, I passed in coupon, and this is actual by actual convention. Actual, and it is used in calculating accrued interest. Okay? Suppose if you bought a bond between coupon dates, okay, then there is some accrued interest. So that accrued interest component is not here. I have relied only like base price. So you can use accrued interest also to increase accuracy uh, for the bond. But yeah, so that is so you can calculate base price. Okay, basically if you pass coupon and this thing like standard like actual by actual or actual by 365 and these then you can determine a base price. Okay, and then based on the base and then you can shift the rates. The point is this is shift size, right? It is one basis point. Okay, this is like this is and you move the whole you move that tenor only. You see, I am not moving the full curve. Okay, I am telling, okay, this tenor is moving. I am moving them one by one. Okay, so first time I will move 1 year, then 2 year, then 3 year. For each iteration I get one erase duration, right? So that will be my KRD for that tenor. And for that KRD, I will get the sensitivity. You see, for if I move that tenor rate up, then I get one price. Okay, so and then price up. Okay, that's price up. Okay, and if I move that tenor down by one basis point, like 1 year rate by one basis point, then I get one more price down. And then I can. So you see, the main point is that you shifted that tenor only by 1 point, one basis point. Okay, and then you calculated the price and same for price down, and then you calculate the KRD. Okay, the simple duration formula. It is the central formula. Okay, why it is called the central formula? You see, I am dividing by base price. Okay, it is normalized by base price. That's why it is central formula. Price up minus price down by shift side. Why did I multiply by 2 in the denominator? Because you see, price up. Uh, so there are two deviations. Okay, it's not like you took one base price and then subtracted from price up. Okay, there are two deviations actually. That's why it is 2 in the denominator. So that's how you calculate your KRD. And how do you calculate spread duration? Okay, so one more simplification I use. Okay, tell me how you calculate uh, credit spread of a bond. You change that credit spread and value the bond so that's how you calculate the sensitivity, okay, of bond to credit spread. But for this experiment, I have assumed that sum of KRD is equal to the modified duration, and that is my spread duration. Okay, and for callable bonds, I have assumed that it is slightly less. Callable bonds have a less total duration because they can be called in by sure. And that's why it is slightly less 0.95. So that's the point. Okay, but this approximation, like, okay, that sum of KRD is equal to modified duration, it is quantitatively justified. Okay, if you don't want to separately calculate your spread duration, but the formula would still again be same. Okay, you fluctuate your credit spread like OS spread, and then you determine two prices and then divided by that shift size, okay, and the base price. So the formula and the methodology remains same, even if you want to dig further into the credit spread. Okay. So now you got two sensitivities, one for rates and one for your reference. No, it's not for FX, it's for credit spread. Okay, one for KRD and one for credit spread. Now you got two sensitivities. Okay. Now third is one is for FX. Okay, why FX is important? Because almost half of my positions are in non-base currency. Okay, when those non-base currencies convert to base currency, then there is the FX risk, right? And there is no hedging in my portfolio. You see, there is no forward contracts. There is no forward contract on the spot for the some bond maturity date. Okay, so whatever the FX rate is valid on that date. Okay, I have to take. I have to accept that. Okay, on bond maturity, this is the FX rate. I need to accept that. So for the valuation date of the portfolio, that rate will be FX rate will be applicable. So that's the main point. Wait, yeah. So how it this FX sensitivity calculation is simple. Okay, so this is again one of them. So so the basic premise is that you need sensitivity to different risk factors. So that's the main point. If you want to do TE attribution, so now you have sensitivity to rates, sensitivity to credit spread. Now third is FX. Okay, FX was the third factor. So that's why you need sensitivity. And the premise is simple actually. Right? It is not a very complicated calculation. Okay, you just multiply the bond price which you got in the previous step by FX rate. Okay? You bump the USD position size, okay, by 1 basis point, and then you decrease that USD position by it's 1 basis point percentage, and then you can then you just like you calculated KRD, right? You calculated the FX. The C is just this duplicate of KRD calculation. Bond price up, bond price down, and it is important to remember that, okay, this line is very important. FX sensitivity in former USD should be positive. Why it should be positive? Because if USD strengthens, then position value increases in euro. Okay, so that's why it has to be positive. And so this is same for okay, for a duration it was different. It is you go back. For the KRD, it was different, right? Sensitivity should be negative, meaning if the rates rise, then the bond value goes. So that was important distinction, okay? And for FX, it's this, and same was for spread duration. Should be negative because if OS rises, then bond positions value position value goes. Alright, so that was the main point. Okay, now the next point is then you have calculated FX sensitivity, KRD, and credit spread. Okay. Now you have to calculate net weight. What is net weight? Net weight is nothing but this. Okay. It is my weight of the holding minus weight of for the same security in the benchmark. For example, for Apple 2027, my weight was like 0.075. So now it was 0.08. Okay. So 0.075 minus 0.08 equal to minus 0.004. Okay. So that is the weight of Apple. Negative. Okay. Because benchmark holding had more weight. That's why it's more. These are the ingredients. Okay. That you need. And okay, now you have, and based on monthly changes, you have calculated monthly changes in this. You have calculated the covariance. Let me show you the code for calculating covariance. So, I think it was, yes. Uh, yeah. I have taken for 5 years. Okay, remember, I have taken 5 years because I did not want regime change to be a problem because these correlations and covariances, there are unstable parameters. You have to calculate it in a particular regime. So I have chosen 5 years regime, last 5 years, hoping that okay, I am not experiencing any change in volatility or anything. But I can be right also because if you see, this is 2025 and last regime changed after like COVID scenario. After COVID, the volatility of rates has been pretty constant. Uh, and volatility of OS also has been constant. Okay, so that is a new regime after COVID-19. So I think that I am correct here choosing the 5 year look back period for calculating volatility. And yeah, so that's how I calculated rates. Let me check if anything important. Okay, so that's how we have calculated variance monthly covariance. So, so Python provides a covariance function, correlation covariance function, and for you can easily scale covariance to 12 months. Because you see, you have done all this covariance calculation on monthly changes, right? So it is a monthly covariance. And covariance changes linearly with time, okay? Linearly, okay? Not with the square root. So yeah, you can straight away multiply with 12, okay? If you want, if you are doing your calculation yearly, right? Because tracking error calculation volatility, you want to do it yearly fashion. So you have to be consistent in units, okay? That's why multiplication with 12. Multiplication. You see volatility does not scale linearly. It scales with square root of time. And you can calculate correlation just like that. Calculate. Yeah. Yeah. Okay. And now what? So okay, let me go back. Um, so okay, now that is now after that you calculated covariance matrix and then you okay now okay, but now you have net weight, now you have covariance matrix, now you want to calculate tracking error of the portfolio, right? That's why we are doing all this exercise. Let's see. It is tracking error. Okay, so now so this is important, okay? Exposure vector. So now you have to multiply your net weight with your sensitivity. So it is a simple thing, okay? Whenever you want to do any tracking error attribution, tracking error volatility attribution, then you have only need covariance of all the factors, okay? First thing, covariance of all the factors. You need sensitivity of your portfolio to each risk factor, okay? That's another thing. Sensitivity of your security to each risk factor. So that I showed you with the KRD, spread duration, and FX rate, okay? And the third thing was you needed the net weight. Net weight, okay? Now with your net weight, you calculate exposure vector. Okay, why it is exposure vector? Because it is a matrix notation actually. It contains all your exposure vectors, and we are going to use one dot product after this step because that's why I have started using matrix notation. Now you have your 9 by 9 covariance matrix. So it's just a cleaning up exercise in Python. And so this is formula is important, okay? If you want to calculate total variance, then this is a dot product actually. Matrix dot product. So this is your exposure vector that you calculated earlier, right? Net weight multiplied by sensitivity. Simple as that. Now this is covariance matrix. Then you calculated here based on these rates. Sorry, based on these risk factor movements, monthly movement, right? And you analyze like that linearly with time. And now this, sorry, I was here. So this was I was here, and then you just because it is variance, right? If you want to calculate tracking error volatility, you have to square it. That's why I square of total variance. And now, okay, so if you calculate the tracking error volatility, then you can actually you can calculate marginal tracking error. Then this is the formula. Again, a dot product divided by total volatility. So marginal tracking error is nothing but your sensitivity of your portfolio to different risk factors. It is a again a sensitivity measure for tracking error volatility. I mean, if what is how is the portfolio impacted for per unit change in volatility per unit addition in that risk factor. So that is your marginal TE. And with the help of marginal tracking error volatility, you can calculate the contribution to TE. You just multiply your exposure vector with the marginal TE, then you get the contribution. Okay. Contribution is like total. Okay. If you're 100, if your total tracking error volatility of your yearly tracking error volatility of your portfolio is like 100. Okay. Then you have like 10 risk factors here. Now, what is the contribution for each risk factor? So it is those contribution. They should sum to your tracking error volatility. They should sum to total. We will also see whether they sum to total TEV or not. Yeah. Now, now you can sum your total TEV length. Yeah. This is curve top. Curve means rates. Simple. Curve means rates. Okay. And spread means your credit spread TEV. And your FX tracking. Now you have like contribution for all the risk factors. Now you have marginal T for all the risk factors as well. Now you just send all this data to a file you report. Okay. Now we will see what that data will look like. Okay. Actually, I have all the data in front of me as we speak. So let me see. Okay, what data report. But even before I show you the data, I wanted to show you the covariance matrix. That is interesting. Okay. You see that O, the OS volatility is the least. Okay. The credit spreads, they don't change very often. Maybe the credit markets, they are less volatile than the rates market. But yeah, so that's the volatility was less in the for the OAS. And FX have the highest volatility. Okay. FX markets, they are the most volatile, more than OAS and more than the rates also. If you see, actually, this was supposed to be, I don't know if you are able to see, but this is darker, okay? Then all the cells combined, this is darker. You see, it is much more than rates. It is at least 10 times more than any of these rates, okay? These effects. It is almost 10 times. And if you see that, yeah, almost 10 times. And OS is at least one third of this any of these rates. Okay, so OS is the greatest. So that's the main point, and that's I wanted to show you here as well. Okay, wait. So this is the formula that I just showed you. I think it is. Oh, hmm. Okay. So these are my observations. For euro positions, the curve tracking error was around 7 bits. Okay, and for spread, the tracking error was around 2 bits. Okay. There is a reason, okay? The ratio is like 1:3. Why the ratio? Because OAS variance, okay, it is like one third of tracking error rates variance. You see here, the OS variance is much less than the rate variance. Okay? It is in green. This is the heat map. And therefore, the spread tracking error will be 1/3. Okay, let me show you here. Therefore, these are the, okay? These are. You see the spread tracking is 1/3, almost 1/3, okay, because the variance is 1/3. Okay. Now for the USD positions, it becomes different. USD positions, FX comes in the picture, right? You're converting your USD foreign currency positions into base currency for portfolio evaluation in the base currency, right? So FX risk comes into picture, and FX variance is 100 times larger than either OS and rates. So then OS becomes dominant force, and then you see the OS is the dominant force here. Okay, it suffocates the curve tracking error and the government's track tracking. Okay, they become irrelevant. The FX become the supreme force when the FX comes in. So let me show you any further results that and I also did validation. Okay. So this validation, what I was doing that I was summing the individual components and comparing it to tracking error volatility. Okay. It passed actually. There was very minor difference. So yes, the results were good. And this code is also in my GitHub. I have pasted the code. This is a code, and you can have a look, and all the documents like functionality, so that all the things. Everything is uh, on the GitHub. I will give this link. Yeah. So thanks everyone for watching my video. If you had the, if you liked it, and please watch my previous video as well for tracking error volatility. I think I created a video for that. Have a great day, everyone.